Hello, welcome to our session on Investing 101. I call it the basics of investing. I speak to so many clients who are looking for advice in terms of investing from a financial planning point of view. There's so much jargon around it. Endowments, flexible investments, retirement funds, guaranteed income plans, shares. Sometimes we spend so much time focusing on the jargon, trying to understand it, and we do nothing rather than just diving in, learning as we go, but starting. Saving something is better than saving nothing at all. Let's have a look at some of the options that we have available from an investing perspective. I call it Investing 101, the basics, the start to investing. So bear with me, let's talk through it and see if we can understand and get to the bottom of how investing actually works. There are two parameters that we look at when we're investing. The first would be risk, the second would be return. Hopefully, if we're increasing our element of risk, we'd be increasing our element of return. We can have our money sitting in a bank account, a transmission account, a transaction account, a check account. There's all sorts of different terms. But at the end of the day, they're in an account in the bank where we can maneuver our money backwards and forwards, pay debit orders, have cash paid in. That is typically what we call our check account. If we're wanting to now add to that, we could look at increasing it up into types of savings, money markets, fixed accounts, call accounts, fixed deposits over a 12-month or a 6-month period are all just terms that the bank would use to incentivize members to park their money and earn a return on that money. It's important to know what the bank is giving you, what the bank interest rates would be. If we said that we are not getting enough interest, not enough growth from our money in our bank account, we would then start to look at using asset managers to invest with, possibly looking at going through to the Alan Greys of the world, the Coronations, Investec, ABSA, Momentum, Liberty. There's all sorts of different asset managers that are available. I always say to people, it's all those wonderful looking adverts that you see on the TV. I love them. They really are creative. But if we gave our money to the asset managers, they'd be saying to us, where should we put your money? Where would you like it to be invested? And we would then be looking at our first asset class is what we would call a money market fund. It's not a money market account where your money is sitting with one institution, FNB, RNB, Discovery, ABSA, Nedbank, etc. It would be looking at giving our money through to the asset managers, them going and investing it in a money market fund, buying interest rates from various institutions. That hopefully should give you a slightly higher return than what you'd be getting in the bank. Our next asset class that we'd be looking at is what we call bonds. Government bonds, institutional bonds. Those are all typically where investors' money would be parked with an asset manager, lending it out to an institution or a government and getting a return on that capital over a period of time. So typically you'd have a 10-year bond and guaranteed rate of return at that particular point. That's what we call a bond. Our next asset class that we'd look at is a property portfolio. Property portfolio is essentially, in layman's terms, a big pool of money that is given through to asset managers that could be lent out to institutions that are wanting to build shopping centres, for example, big office park complexes, etc., that would then be getting returns based on the rental income and passing those returns on to you, the investor, that had made those funds available. Our last asset class that we look at in this portfolio is equities. There again, giving your money to an asset manager, the asset manager going and buying shares on the stock exchange. There are a multitude of equity portfolios that are available, looking at low-risk equities going through to higher-risk equities. Those equity portfolios typically are going to be investments on the stock exchange, and they're going to give you returns, dividends, over a 6-month term, 12-month term, depending on where those are invested. We'd have low-risk equities and we'd have high-risk equities. And our last asset class that we'd be looking at is offshore. I'm going to come back to that. But if we look at how are we earning income or interest, what type of income are we earning? The cash, your bonds, your property portfolio are returning interest. As I've mentioned earlier, equity is giving us a dividend. We have, as I said, offshore, where we could have equities, cash, bonds, a property, all in an offshore portfolio. Essentially, why that is off the radar in terms of our risk and our return is because we've now not only got the equity risk that we may be having, but also our rand dollar fluctuation, rand sterling, depending on what denomination we've looked at investing in. I want to take a moment now and just talk about various wrappers that are around our investment portfolio. Our first wrapper that we'd be looking at would be what I call a flexible investment. Another word for that might be a unit trust in the market. And essentially what that means is that we can invest in this wrapper and have a multitude of asset classes and asset managers making up our investment within that flexible investment. What's very important there is it could be a recurring investment or it could be a lump sum investment, depending on what your financial situation and your needs are. Those are the conversations that you'd be having with your financial planner. If we look at a unit trust, a flexible investment, your money in your bank account, there is income tax that needs to be paid. There are taxes. The most important thing is to remember that the unit trust, the flexible investment, is going to be taxed in the entity that is owning it. Perhaps it's in your personal name, and in which case the interest or the dividend income will then be added to your taxable income with certain rules and legislation applying. We'd also have the opportunity perhaps to have it in a company, and then the company would be paying for the tax on the growth of that investment. What typically we have is you could have anything, whatever your tax rate is, anything from, let's call it 25% up to 45%, I on what income tax bracket you fall into. The next wrapper that we could be looking at is our, I've gone off the track here. Let's go back a step and just talk of what is our risk. I always say to people, your risk is time. In a perfect world, if you gave me R1, I'd go and buy 1 unit. Now, you hear people say, the market has dropped. It's gone down. And maybe that unit is now costing 90 cents. You'll say, but I've had a loss. And I'd argue, no, you haven't a loss because you haven't sold your unit yet. We need to wait enough time for our unit price to go up so that we can then, and only then, redeem and sell our unit and make a profit. Again, when the market is up, it'll say, oh, my investment has made a return, a positive return. No, because we haven't sold the unit. There might be volatility in terms of the market moving if we're in equities. And that's why we always say that risk is associated to time. Money that we need for a set date should always be in a very low interest, a low risk environment. Where we're looking for capital growth, then we'd start to look at taking on more risk in our investment portfolio. Our second wrapper that we'd be looking at is our endowment wrapper. And essentially what an endowment wrapper means is that it gives you a tax-efficient way to save. Instead of paying tax in your personal or the entity that holds the investment's capacity, you'd now pay the company who owns it. An investment house would be responsible for all the tax reporting and paying tax on it. So, for example, if you were invested in a discovery investment, a discovery endowment, for example, they would be responsible to SARS to pay all of the tax, and they pay at a flat rate of 30%. If you're in a high income tax bracket, 45%, or you're in a trust at 40% tax, you want to be considering an endowment wrapper from a tax point of view. We could make it a little bit more complicated and start talking about estate planning and having estate taxes and capital gains tax, etc., and all of those things. But let's try and keep it simple. It's essentially saying that your endowment is going to be taxed at a flat 30%, the growth within that investment. For that privilege, you need to be investing your money for a minimum period of 5 years. So this is going to typically be our longer term investments, our investments that we're going to leave for a period of time. And we do have access to it. There are rules and terminology and legislation that covers that. But ideally, you want to know that your investment in an endowment would be there for at least a 5-year term. Our last wrapper as such around our investment structure that we're talking about today is our pension fund, our retirement, our provident fund, our retirement annuity. There's all sorts of descriptions to it. But essentially what that wrapper involves is legislation that says that any growth on our investments would not be taxed. And that's an incentive that SARS gives us as investors to allow us to actually build up our capital for retirement so that we can be in a position to look after ourselves when we get to retirement age and not be dependent on the state. For the privilege of that no taxation on growth within your investment, we would then be making sure that our money is only accessible from the age of 55. You may not be retiring at 55. That's okay. But from 55 years of age, you're now legislatively able to access money in your retirement annuity funds. Pension and provident funds have certain rules based on your company and the legislation at that particular point in time. One other area that we do have is our tax-free investments. And what that essentially says is that it allows an investor, a taxpayer, an opportunity to invest in any type of cash, bonds, property, equities, etc., with a certain limited amount on an annual basis. And if that amount is adhered to, then no income tax would be applicable to the growth on that. So tax-free investments means that we're not going to be paying any income tax of any sorts, provided we meet the rules of the minimal amount that we're allowed to contribute on an annual basis, a total amount of $500,000 over my lifetime, and allowing our investments to grow without needing to pay any income tax. It's quite important to know that our 500,000 limit is in our lifetime. So typically money that's going into our tax-free investment, we should be leaving it alone. We shouldn't be touching it. We should only use it on absolutely extreme circumstances. Certainly not money that we'd be putting in and taking out on a regular basis. That essentially is Investing 101. And I'd like to take that opportunity to just say thanks for listening to our session. I hope that it's added some value. And please look out for us. Come and chat to us on our personal email addresses through the Discovery website. And thank you. And have a good evening. Make sure that you start your investing today. Something is better than nothing. And learn as you go. If the return sounds too good to be true, it usually is. Happy investing.